Have you ever wanted to invest in the stock market but felt overwhelmed by all the options? That's where index funds come in. One of the easiest and smartest ways for beginners to start investing. Welcome to Mavic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer, this is not financial advice. So, what is an index fund? Think of it like this. Imagine you go to the grocery store, and instead of picking just one fruit, like only apples, you buy a fruit basket that has apples, bananas, oranges, and more. That way, if one fruit goes bad, you still have others to enjoy. An index fund works the same way. Instead of buying just one company's stock, you invest in a whole group of companies at once. But let's first understand what the word index means. In the stock market, an index is just a list that tracks the performance of a group of companies. One of the most well-known examples is the S&P 500, an index made up of 500 of the biggest and most important companies in the US. These companies come from all kinds of industries, like technology, healthcare, and finance, giving you a little piece of everything. Now, here's something important. The S&P 500 is a weighted index. That means not all companies in it are treated equally. Bigger companies like Apple or Microsoft have more influence on the index than smaller ones. And remember, indexes aren't fixed. Companies can be added or removed based on how well they're doing. That way, the index stays current with the strongest performers. It's like always having a fresh, up-to-date fruit basket, with more of the popular fruits and fewer of the ones going out of season. Index funds are readjusted automatically, without the need for a fund manager. It's more like an algorithm doing the work, quietly updating the fund as the index changes. So they're passively managed. And the benefit of this? It keeps things simple and low cost. And here's an interesting fact. Most actively managed funds, where fund managers carefully choose which stocks to buy and sell, often struggle to outperform index funds, which simply follow the market passively. Incredible, right? These are the main benefits of investing in index funds, and why they're such a popular choice for beginners. Number 1. Low fees. Most index funds charge an annual fee of anywhere from 0.02% to 0.20%. That means if you invest $1,000, you might pay just 20 cents to $2 per year in fees. Pretty affordable, right? And over time, those savings can really add up. Number 2. Diversification. When you invest in an index fund, your money is spread across hundreds of companies. This diversification helps reduce risk. If one company in the fund isn't doing well, others might be doing great, helping to balance things out. Number 3. Performance and compound interest. Index funds are designed to match the market, not beat it. So why does the overall market tend to grow over time, even though individual stocks go up and down? It's because the stock market reflects the growth of the economy. As businesses grow, innovate, and earn more money, their stock prices usually rise. For example, the S&P 500 has had an average annual return of around 8 to 10% over the last 90 years. If you invested $1,000 and earned 8% a year, you'd have over $10,000 after 30 years, even without adding more. But let's say you added $200 every month. After 30 years, at an 8% return, you'd end up with around $310,000. I have a really interesting video talking about how incredible compound interest can be. I will leave the link on the description. But here's something important to remember. Past performance is not a guarantee of future results. That 8% of the S&P is just an average. Some years are much higher, some are lower, and some are negative. We don't have a crystal ball. No one can predict the future. Also, the performance of an index fund will depend on which market or index you're investing in. Not all indexes perform the same. A fund tracking the US market may behave very differently from one focused on international stocks or specific industries. So, while index funds are a smart long-term strategy, they are risky. It's always important to invest based on your goals, timeline, and comfort with risk. And that brings us to our last point, one of the main reasons people love index funds: passive investing. Don't want to spend hours researching stocks or watching the market every day? Good news! With index funds, you don't have to. It's a form of passive investing. Just set it, forget it, and let time do the work. Now let's look at some of the most common types of index funds you'll come across. We'll start with the most popular, which are the stock index funds. Without repeating what I've already mentioned earlier, if you head over to the FinViz map page, you'll get a visual snapshot of the entire S&P 500. Each block on the map represents a company, and its size reflects the company's market capitalization. I think it is a very useful and interesting page. Then we've got Nasdaq 100. This index focuses mostly on large technology and growth companies in the US. So if you believe in the future of tech, this could be appealing, but keep in mind, it's less diversified and can be more volatile. We also have small cap index funds. These focus on smaller companies. They tend to be riskier, but can also offer more growth potential over time. If you want to invest beyond the US, there are international index funds that give you global exposure. The MSCI World Index includes only developed countries, mainly the US, Canada, the UK, Germany, and Japan. It's great for getting global diversification with stable economies. And there are also emerging markets index funds, which invests in developing countries like China, India, Brazil, and South Africa. These markets have more risk, but also more room to grow, so they can bring more opportunity if you're investing long-term. International funds are a great way to spread your investments around the globe, so you're not depending on just one country's economy. If you're looking to invest in something specific that you understand or believe in, sector-specific index funds might be for you. These are usually offered as ETFs, making them easy to buy and sell. Some common examples include healthcare funds, which invest in companies like Pfizer, Johnson & Johnson, and other medical or pharmaceutical firms. Energy funds, which focus on oil, gas, and renewable energy companies. Real estate funds, which invest in property companies and real estate income. No need to buy physical property. Just keep in mind, by focusing on a single sector, they carry higher risk and less diversification than broader index funds. For this video, we're mainly talking about stock index funds, but it's worth mentioning that there are also bond index funds, and they play a different role in your investment plan. If you are interested, let me know in the comments, and I will make a video about them. Big financial companies like Vanguard, BlackRock, and Fidelity are the ones that create and manage index funds. They make sure the fund stays properly balanced, following the index closely. They also handle things like rebalancing the fund when the index changes. For example, when companies are added or removed from the S&P 500. When the companies inside an index fund earn profits, they often share some of those profits with investors in the form of dividends. Now, here's where you have a choice. There are two main types of index funds when it comes to what happens with those dividends. Accumulation funds. These funds automatically reinvest the dividends back into the fund. You don't receive any cash. Instead, your investment quietly grows behind the scenes. This is often more tax efficient because you don't pay taxes until you sell. It's ideal if you're focused on long-term growth and don't need the income right now. Distribution funds. These funds pay the dividends out to you in cash, usually quarterly or once a year. However, in many countries, these payouts are considered taxable income in the year you receive them, even if you reinvest them manually. Here's something many beginners don't know. When you buy or sell an index fund, the order is not completed instantly like a stock. Instead, it's processed at the end of the trading day, based on the fund's net asset value, which is calculated after the market closes. The net asset value is based on the total value of all the fund's assets, minus any costs, divided by the number of shares of the fund. So if you place an order at 11 a.m., for example, it won't go through until the market closes, and you'll get the price based on that day's closing value. Some kind of funds may even take some days to execute your order. That means you won't know exactly what price you'll pay or receive until after the fact. This is where ETFs have a key advantage. ETFs are like a more flexible version of an index fund. They track the same indexes, but they're traded on the stock market just like individual stocks. That means you can buy or sell an ETF anytime during the trading day, and you'll get the price at that exact moment. However, not all ETFs track index funds. Some are actively managed. So if you want to invest in an index fund through an ETF, make sure the ETF actually tracks the index you're targeting. I will make a specific guide for ETFs very soon, so stay tuned. Alright, ready to start investing? But before, please ask yourself, are you saving for something in the short term, or are you investing for the long term, like retirement? Knowing your timeline and risk tolerance helps guide the type of index funds you should choose. This video is mainly focused on the long term, so if you will need the money in the short term, you may want less risk by investing in savings accounts or money market funds. The next step is to decide how much to invest. One of the most popular investment strategies is dollar cost averaging, which means investing smaller amounts consistently over time, like monthly. Dollar cost averaging can help reduce the impact of short-term market ups and downs and is especially recommended. I recently made a really cool video on investment strategies where I break down different real-life scenarios and show how various strategies actually work in practice. Check it out if you're curious. And that's it. I think I covered the vast majority of things you should know before investing in index funds. If this video was useful for you, I would really appreciate it if you liked and subscribed to grow this community bigger. Thanks for watching and see you very soon. Bye.